So, hello, good afternoon, and welcome back. You're very warm welcome here from Munich. Enmacc is back with another webinar today, and we have I think, super interesting topic. One of the most discussed topics in the industry is about power purchase agreements. And again, I'm very happy to have an excellent speaker with us, knowledge matter expert, Henning Bottger. He's a partner at Baringa Partners and leading lots of their commercial and risk projects. We deliberately asked a consultant to join us today and give us a broad perspective. We don't want to hear just the perspective of a producer or an off-taker. There's always some marketing speech in there. Henning had the pleasure to work really with all participants in the market. Can be traders, can be off-takers, producers, and as well the corporates. So I think he has an excellent and broad view on the topic, and he can guide us through. Again, I'm super happy to have lots of questions from you coming up. During the presentation, so simply use the Q&A button at the bottom of the screen, or if you want as well, the chat. And I will collect the questions till the end. If there's some pressing in there, make yourself aware as well, and maybe I can take it into his presentation, but usually it's better to collect the questions coming in and have a concentrated discussion at the end. All right, again, very happy to have you on the webinar today, Henning. I hand over to you, listen to your presentation, and looking forward to the discussion afterwards as well. Thank you.
Let me just share my screen. So Jens, thank you very much for the kind introduction and also the invitation to speak today on the PPA market. As everybody is aware, the PPA market is a very broad topic, so we only have maybe 30 minutes, so these are going to be the focus areas for me today. So we'll touch on a brief context of some of the drivers that are impacting the PPA market and changing that market today. We're then going to deep dive a little bit into the corporate PPA market to look at the motives for that segment as an off-taker. And then we'll spend a bit of time thinking about how traders are adapting to the changing market, how products, services and capabilities need to evolve to maximize the opportunity within the PPA market. So let me start then with the changing market dynamics, which I'm sure everybody's very familiar with. So, first off, obviously we know there is a top-down government driven objective to decarbonize not just the power sector, but the whole economy, with governments more recently announcing their net zero ambitions as well across the board. We then also have, secondly, an important trend for this market, which is the move from subsidy to merchant. So as subsidies have been removed due to power prices and the cost to deliver new projects reaching a state of somewhat of equilibrium, making merchant projects feasible. That's an important second trend. And the third trend at the bottom here is the end user demand growth. So the pledges from the corporates and end users for their sustainability agendas, so the public statements to decarbonize their businesses over the next 10, 15, 20 years, importantly started by the group, the RE100 and now many others. And that will obviously drive demand for renewable over the coming years. So the implications for participants, very high level. On the generator side, obviously there is a need to replace subsidy. You still need debt into projects. You still want to recycle capital to bring investors in, and therefore generators need to replace that through the bankable long-term offtake agreements that create some price certainty. That hole has largely been filled over the last few years then by traders and utilities. And there has been quite a range of very often exotic and complex offtake arrangements have been agreed by traders across Europe and other markets. from a price perspective, anything from simple fixed pricing through to floors, collars, soft floors, and various other agreements. And then more recently as well, people have strayed away just from pay as produced into other volume fixing and load following type arrangements. So then there's a third one, which is the corporates. So they've provided essentially a viable alternative to the generators for long-term offtake agreements. But of course, their motives and drivers are actually very different to those of the traders and utilities. They're being driven by their sustainability goals and objectives rather than necessarily trying to make money in this market. So maybe, as I signaled, let's focus a little bit on the corporate side of things and their motives and the drivers for sustainability on their side. Generally, when it comes to procuring energy, we see four key drivers: traceability of renewables, additionality of the assets, cost certainty, and cost savings. Now, not all corporates behave differently, and therefore we need to understand their motives to understand what their buying behavior and sourcing behavior will be. The thing most corporates agree on is traceability. So the ability to be able to buy or show guarantees of origin and other similar certificates for the power that they procure. Then there's additionality. So this is where a corporate is very keen to be able to articulate that their investment, so their buying of long-term power from a generator, has enabled that generator to build the new asset, so it's additional generation on the grid. This is definitely one where not all corporates agree that this is critical, but certainly the early wave of, you know, the West Coast tech firms from the US have all very much focused on additionality as a primary driver to their sustainability story. The third one is cost certainty, and I think this is a very interesting one, especially from a trader's perspective, because a lot of corporates do actually like cost certainty. They like budgeting, and they often like budgeting over longer terms. So a lot of the standard B2B type contracts in the market enable customers to fix in their prices potentially as and when they choose over, let's say, 3 to 1 year horizons in the liquid window. There are actually quite a few corporates who would actually like to lock in prices much further out as well. 4, 5, and even 6 years is not uncommon for requests. And interestingly here, obviously, this is in contrary to the liquidity in the market that we're seeing. So the drop-off in liquidity makes this cost certainty for some corporates much harder to achieve. Of course, then there are other corporates who want to have day-ahead exposure, floating exposure, to meet their competitive environment that they operate in. So again, it's not a uniform requirement. And then there are cost savings. So the cost savings is the tension point, I guess, in the sustainability objectives of the corporates. So corporates aren't willing to spend just to achieve sustainability. It needs to be, you need to be able to persuade the CFO of the corporate that it's still value for money. But of course, the level of importance people put on sustainability versus demonstrable cost savings is again not uniform across the different companies, but creates a tension in the ability to execute the strategy of the corporate sustainability policies. So the way we have thought about it at Baringa is we like to articulate as shades of green as well. So we think that the buying behavior of the corporates for sourcing and meeting their sustainability objectives can be laid out in a bit of a spectrum, with deep green on the left-hand side. And what do we mean by deep green? This is really the gold standard of sustainability. This is where people are very keen on additionality. They are willing to sign long-term agreements to achieve that additionality. But it's not just about buying volumes to meet your overall level of demand. It's about ensuring that as you're putting intermittency onto the grid, you're reinforcing that grid through providing essentially flexibility, either from your own portfolio or being able to source that from some other source to make sure that your evening peaks in winter are not just, being serviced by gas peakers in the market, but they're actually being able to be serviced by renewable and demonstrable renewable technologies. So that's the deep green end of the spectrum. On the other side of the spectrum is the lighter green shade. This is a very simple view where people are happy to just buy electricity from the wholesale market and then supplement that with guarantees of origin and other traceable certificates to articulate that as green energy. So that is kind of the spectrum, if you like, of the corporate buying behaviours. When we then look at actually their sourcing approach, so how they actually go to market, this chart is just an example from the GB market. So don't worry too much about the names, the data. It's illustrative, but what we've seen, and this trend is true in other markets, is that the top end of the INC or the B2B market has been the most active in the corporate PPA market. And we're talking about, I've mentioned them before, but Facebook, Google, Apple, Microsoft. We've also got the supermarkets getting involved. We've got telcos out to market. And actually quite importantly as well, government buying agencies and government regulated industries and entities. What these entities can do is that they're big enough to be able to spend money, to be able to understand the market and go after price discovery in the market. So what they do is they define their strategy, understand sustainability targets for 2030 or 2040. They then go and run their own tender in the market to go and source different tenor products, additional or operational assets in order to layer in an acceptable risk profile and a build-up of that renewable capacity over time. And these things are expensive to run, but it enables them to get good price discovery and understand that they're getting a good deal from their perspective in the market, and they can prove that they're getting a good deal through having run that process. Now, this is only, however, the top end of the market for this. If you look at even just below that market and into the medium buyer category market, there's a very substantial volume out there of disengaged, if you like, corporates who do have an ambition to become green, but they don't have an easily accessible outlet and access to buying and sourcing green energy, other than the light green end of that renewable spectrum. So unlocking, I guess, the potential of this mass or mid-market activity is definitely something that I think would be an interesting challenge, I guess, to the market and potentially an opportunity from a trader's perspective. So maybe that's on the deep dive for the corporate. So if we maybe step back again then for how the offtake market has adapted to the changes we've just been describing. On the left-hand side, from the generator side, we have the subsidy under the subsidy market essentially starting to decline. That subsidy market, from an offtake agreement perspective, is very familiar, trodden territory for most people, I'm sure, on this webinar, with route to market and imbalance services essentially being offered. That is a very liquid product and a very liquid offering with many traders and other entities offering those services. As we then look on the left-hand side here, some of the green boxes representing the more merchant exposure in the market for renewables. We have some end-of-life assets, we've got assets rolling off subsidy, and we've got new build assets from a merchant perspective needing to be built and financed. Now, they have slightly different demands. They all need route to market and physical access, so that's not going away. Some need shorter tenor market access, which again, a relatively easy product to provide and relatively standardized in the market. And we then go down the spectrum to the medium tenor and the longer term tenor PPAs. And this is where liquidity definitely drops off and the ability to source these contracts is complex, especially at the long-term tenor end. Although the off-takers, utilities, traders, oil majors will provide them, in our experience, there's only really a handful of traders who are willing to offer third-party 10+ year type PPA tenors in the market today, and therefore creating a very illiquid product for new build assets to gain access to. We've mentioned banks here as an off-taker as well. Probably just a word on them because in my experience, at least at the moment, it's hard to generalize their role as they're re-entering this market. So therefore we haven't tried to categorize them here, but I think they're worth keeping an eye on because of potentially interesting trends such as financing of new build assets within that segment. And then we come to the corporates at the bottom. So we've characterized corporates here as an off-taker because they are providing off-take agreements for especially the new build assets as discussed, as well as some medium-term tenors. But the reality is that corporates aren't really in the same category of off-take. And there's two things to note about them. One is that the risk profile that the corporates have and the generators have, they're not a perfect match. In fact, they're kind of far from it. So they're very uneasy partners in these relationships. And I think that can be seen in the complexity it's taken sometimes to sign these agreements over the last 5 years, and the way these are very non-standard agreements as well. Although corporates will sign long-term tenors, they're doing that to access additionality. As discussed before, they don't necessarily want to take 10 or 15-year price fixings into their portfolio. They much prefer going for medium tenors, but new builds do require longer-term tenors really to get their projects properly financed and reduce the merchant tail that their investors are exposed to. Then, of course, corporates also still rely on utilities and traders in order to actually complete the transaction in general. So most corporates won't be their own supplier. They won't have physical route to market access. They won't manage imbalance in-house. And they will be looking for additional risk management services from the traders. So far from really competing with the utilities, they're more of a tripartite relationship between traders, corporates, and the generator. And that tripartite relationship, I guess, is somewhat articulated here. I won't go through the detail, but on the left-hand side, we have the typical physical type PPA that's in the market from a corporate perspective. And on the right-hand side, we have the financial or synthetic PPA structures that exist. In the physical world, the trader plays a much more active role in sleeving the power out of the generator and into the corporate portfolio. Whereas in the financial world, it's really a financial payment agreement between the generator and the corporate off-taker, and the physical flow can be somewhat independent with the supplier, and a route to market agreement being agreed for the generator, acting relatively separately from the financial contract and agreement. However, as I mentioned before on the previous slide, neither of these models really solves the mismatch in risk appetite between the corporate and the generator, and therefore and it's also really focused on the large end of the market, so you're not really engaging that middle ground that we spoke about with a lot of latent demand sitting within it. So when we therefore maybe switch focus a little bit to the role of trading, we've got a couple of hypotheses. One is that actually, the trader is best placed to warehouse risk. So the corporate isn't good at warehousing risk, and the generator isn't good at warehousing risk. The trader can have a very active role in warehousing risk and making access to long-term agreements on the generator, the left-hand side of this picture, easier, and then transforming and turning that risk profile into something that is more acceptable to the customer end on the right-hand side of this picture. it's not a new concept, if you like. It's not a this isn't unheard of activity. It's a vertically integrated utility ultimately. But I think what we're doing here is creating the concept of understanding the corporate demand, corporate risk profile, and enabling essentially different parts of the market to access green. And the way this could work, for example, is if you consider a 10-year PPA being signed by the trader on the left-hand side, and then what you're doing is sitting on obviously long-term price risk within that PPA. And what you can do is essentially salami slice that risk up and understand your risk profile and sell down some 10-year or 12-year or 15-year products to corporates who want those, and then split up the remaining volume into maybe shorter tenors, so that you're maybe sitting not on 10 years, but you're sitting on 4 years or 5 years of risk. And the way you can do that as well is then look at more manageable and accessible products that customers are much more likely to buy, and buy it en masse. And that could even be all the way to a green standard baseload product, for example, with a 5 or 6 or 7 year tenor that people can access. And it's that market making capability and experience of traders that I think the market is missing a little bit at the moment to unlock some of this potential. Yes, it requires taking risk, but B, it does allow you to essentially price adequately for generators who are ultimately driven by their LCOE, so their cost of essentially developing the project with their project returns, as well as enabling the customers on the other side to meet their sustainability objectives, which, as we've discussed before, aren't fully only driven by price. So there is an opportunity here to create that arbitrage and appropriately price the risk that's being taken by the trader. I think some key things need to be true. Integrated thinking needs to happen here. So you can't have a two siloed trading business with upstream desks, downstream desks, etc. This needs to be a more integrated thought process to pass all that risk appropriately. You need effective access to customers. Not everybody has that. And then you need the risk appetite to take and sit on some of that long-term price risk. None of these, again, are necessarily straightforward to manage. I think one last point maybe on this is the platforms that we've seen entering the market, especially for corporate PPAs. This concept is a little bit different to that, because ultimately the platforms are brokers, right? They're not warehousing risk. They're not solving the problem of the difference in risk appetite on the left and right hand side. That needs to be addressed in order to unlock the market potential. So maybe then moving on to the second side of things, and this is where I come back to this deep green concept that we spoke about before. So the ability to not just buy renewable power, but actually be able to articulate yourself as having achieved gold standard by buying intermittent generation, but reinforcing that by enabling more flexibility into the grid at the same time. And this concept is actually not just the right-hand side on the customers, which I think people are very familiar with, obviously, with distributed generation and the growth of the aggregator type market over the last few years. It also is valid on the left-hand side, where ultimately merchant projects are also looking at understanding their risk, because they suddenly have more exposure to negative prices. They have more exposure to curtailment within the grid, and they have essentially potentially the need to diversify some of their revenue away just from wholesale market prices, but maybe dipping into grid service revenue and other aspects as well. So people are investing capex alongside their renewable generation, be that storage, all the way out to the hydrogen type agendas that was obviously very topical at the moment as well. But also some other syncom type components that sit alongside the renewable generators and provide different services. And again, these generators can't monetize that and create route to market for that. So a trader would need to provide those services, optimization capability, and risk management services. On the distributed generation on the customer side, again, you've got batteries potentially, you've got behind the meter process and load shifting activity that can happen. You've got controllable demand, such as in the future as well, more transport and electrification of transport. And these are some things we've been working with our clients on as well on the corporate side, is understanding how these things can be bundled up into packages and services that can be offered by traders to these corporate customers to enable them to basically demonstrate this deep green activity. Now, this has obviously a lot of demand on the traders as well. So some of the boxes in here just represent, good risk management, agile technology, a good data backbone, rapid product development that's required to respond to these changing markets, and a real customer focus. I think this is one of those key success factors for this type of activity, is having a very customer-centric model in trading and really understanding your customers. And when we say customers, it's upstream and downstream customers, right? It's all of the market to ensure that you're on top of the market and you gain from that first mover advantage. Because again, using history as a lesson, the aggregator market was actually a very profitable business for the first year or two. But as people piled in, a very thin market became a very unprofitable market over time. And I think it's worth learning these lessons and understanding that the way to access these is to be close to the market, understand what the customers are asking for, offer the services early, create margin and opportunity, but then don't overinvest in it either. Ensure your operations, your technology are fit for purpose to be able to pivot away and go to the next opportunity as well. So that's the area, I guess, that we are also highlighting as a potential area of interest for the traders to access in the context of this aspect of the PPA market over the medium term. So maybe to conclude on some thoughts, I think understanding the market context and looking out for hotspots is an important thing I think people should understand. Some of the concepts we just described are not applicable in every market. You need to understand that the environment is right in those markets. So what do we mean by that? There's the generators, for example, if they have a good, healthy outlet of subsidy, for example, they're not going to go and looking for too many other PPAs, right? So not too much focus. And Germany, I guess, is a good example of that historically over the last few years. Then you need viable, active corporates to drive that demand for renewable new build activity, and the ability, therefore, then for traders to warehouse and diversify that risk out to the corporate base later. And then we mentioned that you can't avoid taking some long-term price risk. So understanding market fundamentals is a key there as well. So which markets have the underlying fundamentals within their generation mix, if you like, and their makeup that enables you to be confident of certain floor pricing, certain ability to not lose your shirt on signing long-term price agreements. Second angle then is corporates and their drive for sustainability targets. So it's not that they are competing with traders for offtake agreements, they're partnering. So understanding their need and bridging the gap the corporate has in accessing this market and making it easy for them to access this market is something that will enable you to unlock a different part of the demand side of this market, which is not necessarily linked to those very aggressive procurement processes that we spoke about for the West Coast tech firms and some of the bigger players, but actually enables people to interact in a more standard way, in the way they're currently used to, through, and giving them access essentially to that illiquid part of the market that they do actually want access to, whilst achieving their sustainability goals at the same time. Then there's the trend around increasing complexity in products. Markets are changing, and the demand for products and the PPA offtake agreements, as well as the downstream products, are gaining in complexity. And I think the ability to be agile and meet these demands, be that, the different types of pricing structure that we spoke about at the beginning, or be it the need to sleeve part of a generation portfolio into 2 or 3 different customer books on behalf of the generator, and then trading the rest of the book on merchant. All those things are demands being placed on traders and services being requested from a generator or a corporate. And being able to react to these quickly as a first mover, we spoke about as well. So making the margin at the beginning in some of these markets is important. And that requires agility, right? So that's agility not just in your systems, but also in your business processes and your governance structures. Being able to bring products and price products to market quickly is important. And then maybe the last point, which is in complete contradiction probably to the first 2 points, the last 2 points I just made, which is trying to do this at low cost, right? Because we've spoken about things becoming commoditized. There are things that are commoditized, and to be competing in a commoditized market, you have to think about automation, low touch processes, and all these other components, and therefore being very smart in how you invest. Partnering with third parties, for example, utilizing their infrastructure, software, technology where possible, so that you don't have to build everything in-house is a definite consideration that people should be looking at. And that goes full circle to my first point, but only if you understand the customer and the market environment you're operating in. So maybe I will stop there and maybe hand back to you, Jens, and see if we've got questions.
Yeah, thank you. Very interesting. We are still waiting for questions, so please, all the participants, feel free to add some on the screen. So they are coming in. Let me start with one question you had on your last chart. You said on the one side, the complexity of the products is still increasing, while we have a commoditization on the other side. So this is, I think, for many people difficult to understand as well, that the complexity in this market is still increasing, and we don't see this kind of more standardization happening here. And there we have one question coming in, which is, I think, following up on that, there are new standard PPA contracts by EFET coming out to the market. Are they helping? Do they have an impact? So how's this standardization versus commoditization playing out in the mid and long term?
It's a very good question. I mean, I think yes, of course, standardization helps. Right? That's just a fact, and everybody wants standardization because it creates the ability to transact quickly. But I think when it also comes to ability to make margin on things, sometimes standardization isn't what you want either, and you want to be able to respond to the differing needs. And I think that's where I think standardization on the generator side may be more achievable than necessarily on the downstream side. So I think generator PPAs are probably better understood. The demands are probably simpler, and we're understanding that merchant exposure is required. It's quite clear what new builds are trying to achieve. They need a bankable offtake structure. So I think that standardization side, I think will happen and will help. But if you're then starting to access downstream markets, I don't think those markets have understood what they want yet, and therefore trying to standardize something which isn't understood is going to be quite hard.
And you mentioned that it's super important to be close to the customer, really understand the market. And you mentioned there are two sides of the market. Do you have to cover both sides? Do you have to excel in on both levels, or is there specialization possible? That the one side focusing on the generators and the others more on the corporate side of the business?
I think naturally that is true in terms of people do that naturally. But I do think there is an opportunity right now to make the market by understanding both sides. And I think therefore being in a position where you can understand both sides is a valuable place to be. And this is back to being able to understand the risk you're taking on the upstream side and understanding that generator portfolio and being good at delivering, power to the grid from a generator. But then being able to warehouse that risk and break it into chunks that a customer is willing to access and buy. And I think that comes back to this liquidity question in the medium term for me, being able to understand the need of that customer segment and accessing it. Now, I think once that market is made a little bit, once you're in that market, the market maker role initially has gone away. I think then you can start looking at that becoming a more standard model. And you potentially start focusing more on one side and versus the other side, yes. But I think right now, I think there is an opportunity to create a market that isn't there today.
Interesting. I mean, we see it ourselves on the platform that we have some longer term trades, and we are interested in extending that further. That's definitely an area to look at where we think as well about. You mentioned that technology and low cost is you need to think about that from the beginning in order to get the cost down. There's one question coming in here. Where do you see software and technology playing a role at the traders providing these PPAs in the future market? So what's the technology and software perspective?
Apologies, do you mind repeating that? Just I'm sure I'm answering the question correctly.
Here the question is around what does the software and technology play kind of a role, especially from the trader's perspective. I think it most probably goes in the direction as well. Does everyone have to develop its own technology here? Can you excel? Can you be highly competitive in doing so? Or
yeah, so I think the software market is playing catch up a little bit in this area. So I think the reality is that some of the early movers have definitely developed more of their own software. That is true for, you know, the sort of ability to, I guess, taking in real-time data, processing data, looking at the forecasting activity for these models, pricing up these products, and then all the way through to taking that physical power to market. But I think that market is changing, and I think, you know, from 10 years ago to now, even just the ability for data backbones to be acquired through sensible software solutions to create a good structure for you to then build essentially applications effectively on top of that backbone, I think is the way forward. So I think it's about understanding where you differentiate your business and where you are creating differentiation within your value chain of the services you're providing. So if you take a standard PPA model, for example, of, you know, providing route to market service for physical assets, it's all about market intelligence, if you like, on the forecasting side, bringing in the right data, being able to process that very quickly, and being able to dip into the market to manage your imbalance risk in short and real time at a low cost, right? So your traditional shift desk with lots of shift traders probably needs to look a little bit different, and it's probably a lot of, you know, essentially robots and algorithms running those processes for you. So I think a healthy balance these days is probably the right approach, and focusing very much on utilizing the market software where it's feasible, and especially in the data backbone territory, and then building on top of that some applications, some from third parties and some that you develop in-house to create your differentiation.
Yeah, there are two questions I try to combine here, which go a little bit in the direction, how big is this market at the end? I mean, we see some strong growth rates still here, but we are aware as well of limitations, which could be, let's say, the credit worthiness of the off-takers, the corporates on the one side, and you mentioned as well the willingness of the utilities in between, or the traders, to take risk, which is ultimately propelling the market. Two limitations, how big can this become?
That's a very good question. So I think right now we're still very much in a growth phase for these markets, as we said, right? With the trends of commitments for sustainability agendas over the next 10 to 15 years, the market's still growing. The decarbonisation commitments are still there. I think the constraints and limits are, however, real ones, and I think we do need to find out a way of sensibly financing and packaging up risk. So corporate credit risk is not something that most people will want to have on their portfolio, and if you take it all the way up to the investor, it's not something that they will necessarily accept, especially when you're talking about infrastructure capital and pension money. So I think that, you know, that there is growth, there is capital willing to flow into here, but the ability for some of these organizations to carry risk over that 10 to 15 year horizon is limited. I think there is enough capacity for that to happen in the market today. And I think, packaging up that risk can help manage that risk a little bit, as we described. But I also think there is a bigger risk probably that in 5 years' time, it'll be very hard to start pricing 10 and 15 year PPAs without clarity in where the market structure is going. Because I think we all recognize that under a net zero type environment, the current wholesale market structure needs to at least be looked at, if not changed. So I think there's a bit of a golden age at the moment over the next 5 years or so where pricing these deals is feasible and possible, and managing the risk, to be honest, over that 10 to 15 year horizon is achievable. Beyond that, I think we will see people starting to dry out in those long tenors and being able to offer those long tenors as traders without significant clarity in market design for the 2035-40 horizon.
Yep. There's one question asking for who will be more successful in the PPA market: traders, utilities, developers. If I see it right, I mean, many of the big players like Ørsted are very good at what they do because they have this kind of integrated perspective on the whole value chain in a way. How do you see that?
Yeah, it's interesting. I mean,
you could ask the question as well differently: who's making money at the end, or
yeah.
what? I mean, yeah.
It's just interesting. I mean, I don't know if anybody from Ørsted's on, so apologies if I do this. But Ørsted is an interesting one. You're right, because they have from my perspective, a good integrated model. They're clear about their value proposition in developing assets, and therefore the key is for those assets to be able to be financed properly and to recycle capital out of the assets once developed. So what they do, my understanding for what they do, is they put this long-term PPAs in place with their trading business, if you like, to de-risk the generation development business and enable that capital to be recycled against a high-quality long-term PPA. And then it's the trading business, as we described a little bit, that goes out and looks to manage that risk. And this is where you can see some of the, this is all public information, but you can see some of the corporate agreements that have been signed by Ørsted, not just on new builds, but they're also in operational assets. And some of these are quite small clip sizes compared to the size of an offshore wind farm, 25 megawatts here and there. But that's the process of decomposing risk and being able to farm out risk over time, rather than having to rely on a one-off process right at the beginning, just before you get to FID as a developer. Right? So it's a good model, I think, from that perspective.
We have many questions around the just recent changes in the market or the circumstances we live in. I mean, the prices dropped on a very low level now. Usually the future prices on the PPAs are significantly higher. How is that affecting the market, and how is maybe the market as well reacting regarding length of tenors? Is it more long, short term? Do you see some shifts happening there?
It's interesting. I mean, it's hard, right? I mean, COVID is hard to predict. So I think the reality that it's added another risk component to the pricing mechanism in long-term markets. I think that's true. And when I spoke about market fundamentals and the floor pricing and understanding how low prices can go and creating some resilience, I mean, COVID has tested that floor this year. In terms of gas prices and oil prices going negative and all those sort of things. So I think yes, there's a bit of a shock that translates probably into risk pricing and risk aversion to some of these things. I think the other aspect of this, though, is that from a corporate perspective, corporates are not mature buyers of these activities. So when you take a deal up to the CFO for approval, it's a very simple question of how much is it and how much do we pay today. The concept of what the price might be in 10 or 15 years time is lost a little bit from the CFO today. So it does, you're unlikely to be able to sign an additional PPA priced in the 40s, let's say, or 30s, versus a market that is in the 20s or somewhere else. So it's a difficult argument to make. So I can see a slowing down in corporate PPAs at this stage. Yeah, so I think that's my view probably on the impact and the shock of the market. I think it will create a bit of a drag because of the additional risk factor that maybe people historically haven't been thinking about or pricing into their long-term views.
Sorry, my camera. Just a second. So my camera died. I think we will come slowly to an end. One more question. Many of our customers, which I have in mind, are, let's say, as well, Stadtwerke who are active in trading and hedging their business. What kind of role can you envision for these kind of smaller players who are not defined as trading shops really in the PPA? Is it a threat? Are there any opportunities? What action do they need to take?
It's interesting. I mean, obviously, Stadtwerke are not one type either. I guess you have the very different sizes and nature of the business for the different Stadtwerke. I think there are some interesting partnering opportunities. Maybe is one way of looking at it. For those who are not necessarily active in sourcing generation upstream, but do have an active downstream customer base. I think the Stadtwerke could effectively be a large customer to a trading business, right? They could be seen as a large off-taker who you sell and structure risk-adjusted green products to, which can then service the needs of the customer portfolio. I can see that as being one role. I think another role is for some of the bigger Stadtwerke. I think that integrated thinking is something that they're actually very good at because of the scale of the business. They naturally fit into the more integrated view of the world, and therefore, if they are able to go and source and manage some of the risk on their balance sheet as well as their risk appetite, then they could, in theory, locally unlock some of this demand. And I think the third aspect to this is probably the local comment I just made. There is a bit of a shift in the offtake market as well, to not necessarily buy Spanish solar, let's say, for renewable demand in Germany. So some more localization of the sourcing arrangements and the sustainability agenda for some of these corporates is also playing a role, which I can see Stadtwerke being very well placed to service.
Absolutely. We could continue forever, I think. There's still some questions coming in, but I see we said we stick to less than an hour here to keep it manageable for everyone. I have to thank everyone. Henning, you first, and all the participants as well, who are quite active here questioning. Very interesting, in my opinion. We are back on the 2nd of July. Sorry, on the 2nd of July, we have a guest from Boston Consulting Group and as well from Refinitiv. We will talk more about digitization and trading. Very interesting topic as well. Hope to see many of you back beginning of July, and thank you very much. Have a nice late afternoon.